2022 was not a great year for Disney stock, as we saw declines accelerated from the highs of 2021. Altogether, the stock is down over 40% there, which puts Disney now at a market cap of $204 billion US, a PE in the 60s. However, if we do take a look at this from a year-to-date perspective, for 2023, the stock is up, north of 25%. And now they've reported their Q4 earnings, so it's time to make an analysis so that us value investors can figure out whether Disney is a buy, sell, or hold at these levels. So make sure to stick around as we answer all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, we're going to look at this from a fundamental perspective. We'll take a look at the trajectory of this business. We'll use all that in conjunction with our calculator here to project out on the business and see where buying points are present for Disney stock. And finally, we'll conclude off with an investment rating for this business. Now, if you do enjoy this type of content, make sure to smash that like button. Also, make sure to subscribe and definitely make sure to leave your thoughts in the comment section below. With all that out of the way, let's jump into the analysis. All right, so Disney's Q1 fiscal year 2023 earnings results, what have they reported on? Well, they actually came in here and beat analysts' expectations there by about 20 cents on that bottom line. And not only on bottom line, but they also beat analysts' expectations on that revenue side, an extra $230 million worth there. It's actually a 7.7% increase on a year-over-year basis. And so altogether, you saw that increase after hours in the stock price as a result. They're working on gaining more market share in terms of those subscribers. And one of their strategies is to reduce costs so that people feel more incentivized to purchase their subscription. Of course, they do have a lot of competition. We'll talk more about that in just a moment. We can see though, if we look at this chart here from Main Street Financial Data, the first link in the description, and an amazing investment resource for us value investors. We can see here by this chart, we can actually analyze their subscriber growth over the last few years. As you can see, since 2019, we've seen a massive growth here, now up into that 250 million figure across Disney Plus, Hulu, and ESPN. Not a great lot of growth there on a quarter-over-quarter perspective, but you're going to want to see how this progresses over the next few years as they look to ramp up those numbers. Now, if we look at this from an average revenue per paying subscriber basis, in terms of Disney, ESPN, things like that, relatively flat. Even though they are making things a little bit cheaper there, they're still maintaining, and actually we've seen slight growth there on a quarter-over-quarter basis, but they're still maintaining those levels there. We've seen Hulu Live at least really taking off there, up into almost $90 per subscriber. Again, something to keep an eye on there for investors. Okay, now when we get down here and look at their segment revenues, you can see here Disney Media and Entertainment came in with about $14 billion. Let's just call it $15 billion worth in revenues for this quarter. That's a 1% growth on last year's results. Now, if we look at this from Disney Parks and Experiences, we actually saw a 21% growth on a year-over-year basis, up to $8.7, almost $9 billion worth in revenues. Altogether, $23.5 billion worth of revenues, another 8% increase on a year-over-year basis. That's great, but once we deduct for all of our expenses and whatnot, Disney Media and Entertainment is actually not producing any type of profits at this current point. We can call this break even at a $10 million loss there. Last year, this time though, they did have about 800 million, almost $1 billion worth in profits, at least from operating the business. And to compensate for those losses, they did actually have an improvement on their Disney Parks and Experiences segment there, up to $3 billion and 25% increase year over year. Altogether though, if you add all of them up, 7% decline on a year over year basis, just $3 billion worth in operating income. So if you wanted to break that down a little further, just looking at their Disney Media and Entertainment section, as we talked about that 1% increase on revenues, you can see the changes that they've had there on a year over year basis. But what I really want to focus on here is their operating income here, down 16%. They're really spending on their linear networks, spending more on direct to consumer, almost an 80% decline there. And of course, that's because they're going to want to spend more on things like content so that they can entice not only more subscribers, but to actually retain those subscribers, as it is a very competitive sector that they are operating within in terms of streaming, at least. Okay, altogether, like we mentioned, that decline, massive decline there, at least on a fundamental basis. Now, when we look at this from a revenue by segment, we can see over the last few quarters here, they have been able to maintain those media and entertainment revenues while also growing on their parks and experiences. And so looking at this from a profit perspective here, you can almost see the absolute 180 that this business has done. Of course, when we had a lot of lockdowns, the main thing that was holding this business up was their media and entertainment side of the business. Now that people are outside more, it's the opposite, where the only profitable segment here is their parks and experiences. And I think this is actually a good thing here, because while Parks and Experiences is now profitable once again, and obviously we're not really expecting much more lockdowns, of course, knock on wood for that, but with the media and entertainment segment, it allows them to kind of build up and incur a little bit of losses here, which you kind of need in order to grow a new business, spending more than you make to build up those revenues. But if they can build up those revenues, maintain those costs, build up into a profitable business like they once were back in 2019 and 2021, you're going to really see the operating income expand from these levels here. And so ultimately we've seen that recovery on their margins from those 2020 levels, and you're going to want to just see how they can maintain that, and hopefully they don't have any more dips in margins in the future, and that it can actually improve from these levels. Now, if we look at this from a liquidity point of view, $8.5 billion worth of cash on that balance sheet. When we look at this from a debt to cash ratio, they have about $45 billion worth of debt on that balance sheet, again, on just $8 billion worth of cash. Now they have a ton of assets on the balance sheet here, lots of content rights, licenses. Obviously they have massive parks and experiences, roller coasters, all these kind of things on that balance sheet as well. So that kind of allows you to overlook this net debt position that they do have on the balance sheet just a little bit there. It's not something that should really concern investors too heavily. And then when we look at this from a free cash flow perspective, free cash flow, at least for this quarter, came in at a negative free cash outflow figure of $2 billion. Again, that's $1 billion acceleration onto the downside on a year-over-year basis. So it's not much you can really do with that to reward shareholders. And what you're going to see down here is that they're really just focused on their debt consolidation, at least in terms of financing activities. Finally, that leaves us with our operating income from an annual perspective. Once again, we've seen how this business has had that slash in operating incomes, especially in 2020. We know what happened there, but we have been recovering these revenues already. For the first quarter of 2023, they came in with about $3 billion worth of those operating income. Now, last year they did the same thing in the first quarter, so they do have a strong, technical fourth quarter of 2022 with that holiday period. We're going to want to see, obviously, if they extrapolate on that for the next 3 quarters, it would be equivalent to about $12 billion in operating income. So if we expect that they can at least improve on last year's results by about $1.5 billion, let's call it $7.5 billion worth by the end of 2023. If we require a 10% return, they did cut their dividend there. And we expect that this business can only grow at about 6% for the next 5 years. That tapers off to just 4% growth for the 5 to 10 years after that on a 45 PE. Let's say the PE does come down a little bit there. This business would be, fairly valued for where we're trading at after hours from this growth perspective. Now, in the best case scenario, let's assume they can actually grow at about 12% for the next 5 years. Then that drops down to about 8% for the 5 years after that. On a 50 PE, the stock would be trading at $200 per share. Some nice stock appreciation there, which is exactly what you'd be looking for here, considering they did cut that dividend like we mentioned. Now, in the very worst case scenario here, negative 1% growth rate for the first 5 years. They finally have a rebound there, finally get, Disney Plus and things like that off the ground and running. Higher profits there, growing at just 4% though. On a 35 PE, the stock would only be worth about $67 at that current point in time. Again, obviously this in the worst case scenario there, and you're going to want to see if they can actually achieve that previous profitability that they were able to achieve, before 2020, back into $15 billion or so just from their parks and experiences. Then you can imagine if they can add on their subscriber growth and streaming services, let's imagine they can come in with about $15 billion worth in operating income. We can see how that really impacts these fundamentals there, and that even in the worst case scenario, if they can get back to, $15 billion worth in operating income on an annual basis, the margin of safety level would be above where the stock is currently trading at. And that's really the growth perspective here with Disney stock. Imagine if they did tack on a dividend on top of that, you can really see where this business would be trading at, and especially in the worst case scenario down here. Now that leads us to our competitive analysis here. We have Disney, Netflix, and Warner Brothers Discovery here. And, obviously Disney is a very unique business with parks and experiences there, so we're kind of just comparing the streaming segment here for these businesses. And so we have Netflix obviously strictly streaming there, and they have $5 billion worth in operating income. This $6 billion worth in operating income for Disney comes from their parks and experiences. So Netflix has about a $5 billion head start on the streaming side of the business there. You're going to want to see if they can catch up to Netflix. Of course, Warner Brothers still unprofitable at this current point in time. Now, if you look at this from a market cap perspective, Disney and Netflix kind of trading in and around that same range. They're not too far off each other. Of course, again, Warner Brothers still not profitable, so they can't really compare with the big dogs in this space here. Now, finally, we'll look at this from a PE perspective, but when we look at Netflix and Disney here. 36 PE for Netflix right now, trading closer to their earnings than Disney is at this current point in time. And the main reason for that is because of the growth prospects we just mentioned, while looking at our calculator here. If they can get back to the high levels of operating income that they did have before, and if they can add on that streaming revenue, we'll really see this business fly up from these levels. But when we do look at this from a stock chart perspective here, and considering they are at a 63 PE at this current point in time, I'm only going to give this an investment rating of about a 6, simply because we're trading at quite a lofty PE. Investors are really expecting that this business can boost up those fundamentals so that they can actually get back to where they were previously, up almost at $200 per share. And it's very doable scenario like we mentioned earlier. 2023 is going to be a very crucial year for Disney stock, because if they can improve on their fundamentals, now that we are kind of trading in a more normal scenario with less lockdowns, things like that, we're going to see those fundamentals improve from these levels. I know we're even still going through, economic hardship, and they've been able to improve the fundamentals to the level they have, at least from their parks and experiences, which goes to show the resilience here behind this business and their strong customer base. Altogether is 6 or 6.5 in terms of investment rating. But that's my thoughts on this analysis. Please leave your thoughts in the comments section below. Also, make sure if you did make it to this point in the video, you like that video and also subscribe. And with all of that, I'll catch you on the next one.